Hello and welcome to today's webinar. I'm Joe Overby, editor of Auto Remarketing. In today's webinar on the 2016 Manheim Used Car Market Report, we're going to learn more from Cox Automotive Chief Economist Tom Webb about some of the trends in this report. But before we get started, I want to go over a few housekeeping items for today's webinar. First, please make sure you have dialed in using your phone number provided in your communication email or are able to listen through your PC's speakers. We are recording today's webinar and will make the recording and presentation available to you in the coming days. You will be in listen-only mode for this webinar. We will reserve some time after the presentation for Q&A. You can submit your questions at any time through the questions box on the GoToWebinar control panel. If we aren't able to get to your questions today, don't worry. We'll forward it to Tom and the team at Manheim so that they can respond back to you directly via email. Lastly, if you have any difficulty during the webinar, please click on the hand icon on the GoToWebinar control panel to alert a member of our webinar team. At this time, I'd like to introduce Tom Webb, the Chief Economist at Cox Automotive. Tom has 40 years of automotive experience, including auto analyst roles with NADA, PricewaterhouseCoopers, Manheim, and Cox Automotive. Tom is one of the industry's leading resources when it comes to providing analysis of used car market activity and much more. His insight is based on data from all of Manheim's operating locations and associated businesses, plus a fair bit of industry research. So without further ado, take it away, Tom.
Thank you, Joe, and thank all of you for joining our webinar today. If you've followed automotive remarketing for the past month, there's no way that you don't know that this is an Ask Me Anything segment. Joe has been actively soliciting your questions, and given his readership, I'm sure he's received tons of them, some of which I suspect will be doozies. And I want to quickly get to those, so I'll try to keep my opening remarks as brief as possible. But I do want to give you the backstory from which I view things. It's a backstory which is basically simple, straightforward, and I think uncontroversial, namely that the coming increases in wholesale supplies will put downward pressure on wholesale pricing and retail margins. Therefore, to build on the success that dealers have had in recent years, and these have been great years, they will still need to make continuous further improvement in their ability to efficiently and effectively secure and manage used vehicle inventory. And in addition, we will also need a continuation of what has been a very favorable, healthy retail environment. So will we get that? Well, I'm certainly going to leave that to the Q&A. I just want to briefly run down and quantify some of those coming increases in wholesale supply by type of vehicle and source, and note some aspects that may be important to you and indicate how it may impact future pricing and margins. So let's start with the biggest story in the industry, of course, and that is new lease originations. They troughed at about 1.1 million units in 2009, and last year they reached a record of nearly 4 million. This was because of both higher new vehicle sales and a higher lease penetration rate, to which I often add as a side note, this is not a bad thing. I would say today's lease penetration rate, if anything, is too low, not too high, because there are certainly more households that are in an extremely long retail finance contract that would have been better off than a lease, than vice versa. More importantly today, I think we have, for the most part, what we call leasing done right. The right car, the right customer, the right residual, and the right end-of-term remarketing practice. But whether leasing is done right or wrong, those originations inevitably lead into off-lease volumes. And one of the inherent problems in leasing is that your peak originations will inevitably occur at the top of the economic cycle, which ensures that your end-of-term units will come back into a less favorable environment and possibly even a recession. So now, of course, dealers are not subjected to the residual risk that's inherent in all these vehicles coming back, but they too will feel the pain if lessors incur some end-of-term losses, because in our industry, pain is often shared. So you'll probably see maybe excess wear and tear charges becoming a little stricter, new lease terms a little less generous, and certainly with large amounts of negative equity as opposed to positive equity, lessors and dealers won't be able to use those pull-ahead programs that have been so successful and helpful in the early part of this recovery. But for dealers, there are also benefits of record off-lease volumes. There are big benefits, and they far outweigh the downside. Because what is an end-of-term lease customer? It's someone who literally drives a piece of high-quality inventory right to your door, where you are given the right of first refusal to buy or not to buy at fair market value. And while they're there, in the majority of cases, they ask to be put into a new lease. And of course, if you're an independent dealer, the growing off-lease volumes means that more of these units are going to get into the open auction market, giving you a better and equal opportunity for inventory acquisition. And it's going to be good inventory. More on that later, but let's now just switch to another source of wholesale supply, one where independent dealers buy the majority of units available at auction, off-rental units. New vehicle sales into rental have also grown since the recession, but not nearly as fast as leasing. And sales into rental hopefully won't get back to that previous peak when the manufacturers were stuffing units into the channel at a loss. Because despite higher new vehicle sales in rental last year, they still accounted for only about 10% of all new vehicle sales. And importantly, the mix and makes have become increasingly diverse. This is the share of new vehicle sales into rental as a percent of total new vehicle sales for some major manufacturers. The domestics, Detroit 3, if you will, have made sizable reductions. Some players come in and some go out of the market every year with varying degrees of increases or pullbacks. Now, not only is this off-lease supply becoming more diverse with respect to manufacturers, it's also become more diverse with respect to individual makes and models within those manufacturers. Now, what I did here is I counted the number of unique year, make, model, body configurations of the rental risk units that were sold at Manheim auctions in a given quarter. You can see that in the third quarter of the last year, it was 3,756 unique configurations, which seems like a staggering number, but of course there are a lot of one-offs. So probably more important are the rows that fall below that. For example, you can see in the third quarter of 2015, the top 10 configurations accounted for less than 16% of all off-rental sales, whereas in 2011, they accounted for more than 28% of total sales. Or if you drop to the bottom line, you can see that it now takes 85 configurations to reach 50% of total off-rental sales, whereas in 2011, it was only 31. And us old-timers can remember a time when more than 50% of the off-rental volume was accounted for by models that could be counted on less than 2 hands. And lo and behold, they were all painted white, which certainly hurts residual values and distracts from the excitement in the lanes, and more importantly, it reduces the dealer's choice of inventory acquisition at auction for the types of vehicles that their customers really want. So because of this more disciplined approach, if you will, with respect to rental, I see the number of units coming out of the rental fleet will probably level off in the neighborhood of 1.8 million units per year. So now let us look at the final segment of commercial wholesale supply, which is repossessions. As a backdrop, of course, there is no overemphasizing how important retail financing is to the health of the used vehicle market and wholesale values. And it certainly has been a key factor driving this recovery so far. The dollar amount of auto loans outstanding crossed the 1 trillion mark in the middle of last year. And simply because of that growth, loans outstanding have quickly risen in terms of the numbers that are 90-plus days delinquent. There was about a 500,000 unit increase in the 90-day-plus delinquencies from the third quarter of 2014 to the third quarter of 2015, according to the Federal Reserve Bank of New York. Now, some of that's going to obviously move over into repossessions. So as you can see here, I'm sort of estimating an increase of about 100 or 150,000 increase in the out years. And that is assumes that auto loan portfolios continue to perform extremely well. Certainly if there was a deterioration in the labor market, you would see a bigger spike in terms of repossession volumes. If you add those three segments up together, you get this. And yes, you can see that wholesale supplies are rising very quickly, and they will well reach a new record probably this year, definitely in 2017. Some could argue, however, that this number and the percent increase even are not that big relative to the total wholesale market, which is more than 20 million transactions per year. But most of those other wholesale transactions are dealer consignment at auction or dealer-to-dealer trades. These commercial consignment volumes are different. That's because it is volume that has to be sold, it is volume that will be sold, and it is volume that has to be subsequently retailed, and retailed at a profit. So basically, there's only one adjustment mechanism to make everything work, and that's wholesale transaction price, which is a lot of pressure to put on just one factor. So certainly we will need a continuation of a healthy retail market to make everything work. Well, we get it. Well, if you just focus on the base fundamentals, which always drive the used vehicle market, namely labor market and credit conditions, I think you'd have to make a fair assessment and say that the economy would probably continue on its same path, namely slower than average growth, but probably sustainable growth. You would also have to say that the auto industry remains in a more favorable position than do other sectors of the economy, but you would also have to acknowledge that the possibility that the competitive dynamics could become somewhat destructive in 2016 and beyond. So again, I'm not going to give an economic presentation today, but rather just give you a look and a review of where the auto industry is. This, of course, is the long-term history of new vehicle sales over the past 56 years. It shows that, yes, we are in a cyclical industry. The peak-to-trough swings generally run 25 to 33%, and during the last cycle, it was a whopping 42% of peak-to-trough swing. But last year's sales did reach 17.5 million, which exceeded the previous peak reached back in 2000. So, as I say, sometimes I call this a graph and I label it used vehicle production because that is what it really is. It is not just-in-time production, however. In fact, it is sometimes almost the opposite. Much of this production will hit the market regardless of whether there is any demand for it at all. And in some instances, like we just noted, there are some times where this production will increase when you least want it, for example, repossessions. Now, if we look at the new vehicle SAR on a 3-month moving average basis, you would probably have to say that we are plateauing this year. And as Mike Jackson of AutoNation recently noted, plateauing is not something that the industry normally handles very well. In terms of the used vehicle side of the market, consider this. It's amazing that the 7 publicly traded dealership groups have had 26 consecutive quarters of same-store growth in their used units of retail. And some of those increases have been quite large. And of course, the year-over-year comps get harder and harder as this progression continues. But it is also true that gross margins have continued to narrow, hitting 8.6% in the fourth quarter of last year. Now, there are 2 ways of looking at this graph. One is you could just say it's a very ugly thing to see this decline. Or you could argue that this is simply the case of a competitive industry passing on its efficiency savings to the consumer. And of course, the truth obviously lies somewhere between those two, but growth should not, and hopefully it won't go much lower. Or from a used vehicle valuation perspective, I wouldn't look for operating efficiencies at the retail level to continue to bail out commercial consignors. The dealers have done more than their part in terms of making wholesale operations efficient. So this growing wholesale supply will indeed put some downward pressure on pricing. But before wrapping up with that, let's acknowledge the strength of the CPO market. We've had 5 consecutive years of record sales, and there was strong growth even when available inventory was tight. So to get a sense about how far much these programs can continue to grow, consider this. The bottom line shows for the industry the number of CPO vehicles divided by the number of new units sold in the prior 4 years. Naturally, this percentage is low because the vast majority of those new vehicle sales won't come back into the used vehicle market at all. But nevertheless, the percentage has risen from a little over 2% to over 44% over the past decade. But the key takeaway here is, of course, if you look at these luxury brands that have high lease penetration rates, they have strong CPO programs, and they do a good job of keeping end-of-term lease units within their dealer network, you can see the ratio runs 8% to 10%. So it is my belief that with respect to leasing and CPO market and end-of-term remarketing practices, I think the industry as a whole is moving more to what the luxury brands have always done. So in other words, CPO sales have a lot of runway yet ahead of them. And finally, with respect to wholesale pricing, yesterday we released the Manheim index for February. It did show its largest decline in more than 3 years. It brought the index right back to the trend level. Certainly it is our expectations that with the growing wholesale supply, that these used vehicle values will fall back below that trend level for most of this year and probably next year, but not anticipating anything that could be unmanageable in terms of the remarketing process. The key is stability, and if you look at the annual average change in the Manheim index, you can see that the last several years have shown a tremendous amount of stability in wholesale pricing. So a movement down of 2 to 3% is not going to shake the world. Bigger declines are harmful because basically no one benefits from volatility in wholesale pricing. Certainly dealers get hurt when there's a significant increase in wholesale prices. They get hurt when there are significant declines. Stability would be the best thing for them. And it looks like we may have that for some time. So, you know, in summary, yeah, we're going to have higher used vehicle retail sales next year. We simply have to have them because of the increase of wholesale supply. The question is what sort of profitability are those sales going to provide the dealer network? I think the new vehicle sales pace is, in fact, you know, sort of leveling off. How will we manage that? The overall economy, certainly the recession risks are rising, but they're still in the near term relatively low. Getting out to 17 and 18 is probably a bigger problem. And in terms of retail financing, this credit cycle has further to run. There has been some consternation recently in the press in terms of increases in delinquency rates, but still they are in fact extremely low. Wall Street is still providing tremendous access to funds for lenders. The only problems where there had been would be some of the small subprime, deep subprime lenders who do not have a very long track record in the industry, certainly the rating agencies are less likely to provide them with the fundings without more significant credit enhancements. So there's a little bit of pullback, but it's certainly, given how great the credit environment has been, one should just sort of expect that. And certainly overall, it remains a net positive. So with that, I'll open up to any questions we might have. Thank you.
Thank you, Tom. And just a reminder that if you do have any questions, be sure to type them in the questions box, which is on your GoToWebinar control panel. We'll go to our first question here. It says, what percentage of off-lease vehicles are being accepted by the grounding dealer versus being sold in the wholesale marketplace? Again, that's what percentage of off-lease vehicles are being accepted by the grounding dealer versus being sold in the wholesale market.
Yeah, well, certainly there's some definitional issues there, but the way I would look at it, and certainly obviously there's big changes between individual lessors and what their return rates are, but generally speaking, you're looking in the neighborhood of 55% would come back into the remarketing process. So the others would be to the grounding dealer, to the lessee, or to a closed channel to the network without any competitive bid process involved. So somewhere in that length area, and it will go up when the wholesale supplies increase. It will go up, but it won't get back to where it was in earlier cycles when the remarketing processes weren't as efficient as they are today, where in many instances you had a return rate of 80, 85% or more.
Thank you, Tom. And our next question deals with the online retail environment. And Tom, what percentage, even a ballpark percentage of buyers are willing to buy a car sight unseen, and maybe what percent are willing to buy without a test drive?
I don't have the ballpark figure on that. Some of our other colleagues at Cox have done these sort of surveys, but certainly totally sight unseen, it is relatively small. Now, of course, with the images and the condition reports getting much better, but still, even then, the test drive, it may not be the exact vehicle that you're going to buy, but you're certainly going to want to test drive that model, at least to have some experience with it.
And then our next question, in the retail market, particularly the CPO market, do you see those added costs of CPO passed along to the customer in terms of additional value, or does that added cost of CPO come out of the dealer's profit?
Well, the programs, to date have worked for all, certainly for the dealer and for the customer, who's tremendous acceptance, and they have helped the lessors support residual values on end-of-term units. The additional gross profit to the dealer on those sales sometimes are pretty skinny and probably not in tune with the extra cost that they have to pay, but often they accept that because the CPO units will turn quicker in inventory, and they're certainly going to probably generate higher F&I income. But yeah, the programs sort of vary, and that's why I say in terms of making the programs work, it's the lessor or the captive finance company is going to have to allow dealers to make the additional profit that those sales incur.
Thank you, Tom. Where do you see the spread between new and leased vehicles going?
The spread. The higher volumes, as I said, when you get out to 17 and 18, those are pretty big numbers. So the leasing business, which is obviously dominated by the captives, puts them in a somewhat maybe schizophrenic position where the remarketers through CPO programs and other efforts are trying to support used vehicle residuals, but at the same time you always have the pressure on the front end of the shop wanting to make new leases. So to the extent that you do get aggressive on your new lease originations, you're competing against yourself and trying to support CPO sales. So it's going to become an increasingly difficult fine line to thread when you get out to 17 and 18.
What do you believe is going to happen to the 4 to 7 year old vehicles at the auction marketplace when a flood of off-lease vehicles that are CPO eligible, they have to compete with them in the lanes?
Yeah, I mean, we have the waterfall effect go both up and down in terms of wholesale pricing. So, you know, like I said, even in terms of a off-lease and an off-rental being totally different types of vehicles in terms of the buyer, they do influence values. And we've certainly seen it where some lessors have 2-year-old leases coming back and 3-year-old leases at the same time because they did those programs. That always becomes a difficult sell. So, you know, basically it'll wash itself out. But yes, it's logical to assume that there will be some downward pressure on wholesale pricing throughout the market, but it should be manageable in the near term.
Just a reminder that if you'd like to ask a question, you can submit your question at any time through the questions box on the webinar control panel. Our next question asks, at what point will the softening in the prices of newer model year used vehicles begin to drive down prices of older model year units? Perhaps is there a different scenario if subprime financing starts to dry up?
Yeah, I'm certain that's a key point. I mean, obviously, even without an increase in wholesale supply or with overall prices moving, that segment is the pricing, of course, is extremely sensitive to the availability of subprime financing. In terms of moving down, I think you know, as I say, I don't really do a lot of forecasting of the used vehicle of values, but I would think that the movement that we saw down in February would be the start of a longer-term trend that almost all analysts have been projecting for some time now. As a matter of fact, most were anticipating prices were going to decline last year, when in reality they didn't. They inched up. So yeah, the longer-term trend should start to move down, and I would see it this year. But again, modest, because you're only going to get those big downward movements in wholesale pricing when you have an increase in supply and a reduction in retail demand. The retail demand environment still looks favorable, but once credit turns, yeah, it could be more problematic.
To what degree did the increase in daily rental returns drive the wholesale price decline in February?
It was not a factor. I would say in terms of the industry as a whole, the off-rental volumes actually were not heavy in January or February. I would expect that they would now start to pick up more, because generally speaking, most people believe that the rental car industry is a little bit overfleeted, and they took a significant increase in sales into rental in the first 2 months of this year, a little bit over 13%. So yeah, I mean, I think there are some units that got to come back out.
Next question, where do you see small car wholesale values going this year?
Obviously, that's been the weakest segment of the market for some time. It is trying to find a bottom. It has not found it yet. number one, we do have some, you have some volume there too, because a lot of these small cars were actually leased. The sedan market, consumer tastes, have changed. So certainly, if you were a lessor, you would prefer to be getting back a crossover as opposed to a sedan. So they have not found bottom yet, but given how far down, they must be getting close.
Thank you, Tom. And Tom, where do you see the term time going for sellers based on the consistent increase of overall volume? We're seeing used car volumes go up. And the second part of that question is aged inventory going to be a concern?
No. I mean, the dealers, all good dealers have a strict turn policy. So you don't let it age, but yeah, that means you might have to increase your wholesaling percentage. And that's why the wholesale market exists, to make the turn rate possible. In terms of age units, I mean that would be, the dealer made a mistake. He's got to be resilient in terms of keeping with his policy. You don't make exceptions.
Thank you, Tom. And then, if we look at the new and used car sales, the spread between the number of used car sales on the retail level, the number of new car sales on the retail level, where do you see the spread for that going? Is it going to get wider? Is it going to narrow a bit this year? Where do you see it going?
Well, the used vehicle market is always more stable than the new vehicle side. I personally think that the new vehicle sales are getting close to, if not already have plateaued out. So actually, that means, given the fact that there will be an increase in used vehicle sales, means that they're getting better. If you look at all the publicly traded dealership groups, their used to new ratio has in fact gone up quite a bit. All dealers have become better in terms of used vehicle operations, both franchise dealers and of course independents. So yeah, I think it goes up. I mean, that's where the potential of the market is. I mean, if the 257 million units in operation, if you will, represents both the supply and demand for used vehicles. If the market is efficient and you can make those transactions with, let us say, less friction, you can have lots and lots of transactions, and the market is in fact becoming increasingly efficient.
Thank you, Tom. And going back to the wholesale side of the market, and more about that volume, as we see those volumes increasingly coming back this year, what impact, if any, do you see on residual values?
Well, it's going to be a significant pressure, I think, but it's more of I really think maybe 17 and 18 in terms of those off-lease units, because again, it looks like the retail market will remain favorable of this year. Certainly, we have the possibilities of shocks out there in the economy, but given a normal scenario, the demand is there. Now, at some point, economic recovery only lasts so long. There still is a business cycle. So to assume that it remains as favorable as it is now out to 2018, it's possible, but it's an optimistic assumption.
And then looking at going back to the impact of the rental returns, do you find that there is some regionalization of this impact there, or is it kind of a national trend, or do you see different pockets of the country impact differently than others?
Well, rental car companies, do a fairly significant amount of moving vehicles to where they want them and to where they think they will sell better. And then, of course, in the digital world, you have the other option where, you're bringing the buyers to the cars with your eyes rather than moving the cars to the buyers. But there is a significant amount of movement of off-rental vehicles to where the remarketer thinks that they'll best be sold.
And Tom, how should we think about the scrappage of vehicles, the scrappage rates over the next several years? You know, we're getting more cars on the road, increasing car park. What are the scrappage rates going to look like?
Well, if you look at it as a percent of the units in operation, you'll see that, you know, over time it does go down. The quality and the durability of vehicles is tremendous. It has created, I think, a longer-term problem that we sometimes refer to, the fact that you're going to have vehicles out there that still have an engineering life, but they have no economic life. I mean, nobody really wants them. Can't put too much value on them. So, you know, you have a situation where there is an export market, but relatively speaking, it's small given the amount of vehicles, and recycling of the vehicles is not really there either. So, yeah, I think it presents a problem again where you're going to have a significant number of vehicles which, again, they run, but they just don't have a lot of dollar value.
Thank you. And to shift gears for a second, I wanted to look at some economic trends. And I wanted to see if you could go into details about the U.S. economy and some of the rising recessionary risks, you know, given that the unemployment rate is around 5% and commodity prices such as oil are also kind of stabilizing. What are some overall economic risks and recessionary risks that you're seeing right now in the U.S. economy?
Certainly the number one risk, all the risks almost are international. We have not built up any real excesses in the U.S. economy per se, and certainly not in the automotive industry. But if you look how financial markets are handling this relatively crazy world that we have now of negative interest rates, it's problematic, and to a certain extent, you could say markets are, you know, sometimes haven't even been rational. I mean, there's a lot of movement in January, first part of February, less so today, but now it's moving again somewhat irrationally. The dollar, which normally you would think would strengthen because we're probably going to maybe tighten a little bit more while everyone else has negative rates, the dollar has actually weakened against the yen since it went negative. So it's a mixed up world, I'd say, on in terms of international capital flows and exchange rates, and that, I think, is the number one recession risk.
Tom, from your perspective, have you seen any evidence or any just kind of trends of how the virtual dealership, you know, somebody like a Carvana, or even those within the industry, you know, like what GM's doing through its Shop Click Drive or AutoNation with its online program, how are those faring versus traditional dealerships? Have you noticed anything in terms of anything that stands out about how that type of format is faring versus your traditional dealership model?
Yeah, again, I would say that some of my colleagues would be better able to answer that and have studied that quite, you know, closely. I would just say, as a general observation, you know, what I find impressive is that the fact that what you might call a traditional franchise dealer has become so much better in terms of marketing used vehicles and doing it effectively and efficiently. Therefore, I think, you know, they can make the model work to where the customer, you know, gets the sales process that they want. So I think that's the biggest thing from mine, just an overall view. But again, some of the Cox employees have looked at that more closely than I.
Okay. And going back to CPO, Tom, for some of the mainstream brands to be able to catch up to the luxury brands in CPO, will dealers and or captive finance companies need to be more involved, or do you think this growth will happen organically?
Yeah, the captives will be more involved because of their off-lease volumes. I mean, the CPO programs gives them some different levers to pull. For example, I mean, you can incentivize the CPO sales too with reduced rate financing, for example, and it may be necessary to do that on some particular models in order to support residual values. And certainly the marketing programs are obviously essential. And then, of course, you can also fine-tune exactly what is in the program itself in terms of coverage.
We've seen
but again,
some.
Bottom line, you've got to give the dealer the additional profit opportunity to make it work. It's the dealer who decides the CPO unit or not.
Along those same lines, we've seen a few automakers who've had some success with the lease pull-ahead programs to pull in those CPO inventory. And what are some of the most successful lease pull-ahead programs you've seen, or pull-ahead strategies that you've seen, and how do they differ for the different brands?
Well, I would say that they all have worked extremely well, but it's a whole different world when you can pull ahead
market overseas that's going to drive up wholesale prices?
Well, that one too obviously changes quite a bit from year to year, where the countries are somewhat dependent on exchange rates, and of course there's regulatory issues also. So it does swing quite a bit. I mean, overall, although again the exchange rates have not moved as normally as you would expect, but the longer term bet would be that the dollar gets stronger, which basically reduces that foreign buyer demand a little bit.
To go back to the economy for a minute, Tom, what are some of the other factors that you see as contributing to the rising recessionary risk? Anything involving increased credit lending that may impact the recessionary risk there?
No, I do not think that the auto lenders have been overly aggressive so far. Certainly at some point, it's a normal credit cycle. They will start making some poorer underwriting decisions, but I do not think that they have done that. And therefore, if it's not bad underwriting, then generally speaking, your delinquency rates remain extremely low, except if labor market conditions would become less favorable.
And sticking within the finance realm, what % of just total annual repossessions do you see that come from the subprime segment?
Well, the majority do come from used vehicle finance contracts as opposed to new. And then on the used vehicle side, the majority is, non-prime, subprime, deep subprime. So yeah, that's primary it is, because that's where, you built a business model with relatively high levels of repossession risks entailed, and and hopefully you priced it right.
Tom, we're gonna turn to our neighbors to the north and ask this question: what's the impact you're seeing of imported Canadian used vehicles coming to the United States from Canadian auctions? Are you seeing any impact in the United States from the importing of Canadian vehicles?
Yes, and again, this is an area which I pretty much just concentrate on the U.S., but certainly I know our general manager in Detroit, and she is loving the fact that the loonie has driven through this market where you're getting increased volumes. Yeah.
And Tom, you know, as we see lease penetration continuing to increase, you know, and with presumably strong residual values, do you expect an increase in the estimated 55% of cars that pass through the closed auction sale? I guess, in other words, do you see more of those cars going through the closed sale?
No, I mean, as the wholesale values fall, then your return rate goes up. It's not going to go up as fast as it did in the past because of different remarketing practices, but definitely it will go up, and they'll end up in the broader market. There are some lessors who, you know, fully recognize because of the sheer volume that their own dealer network cannot handle all those units. That they need outside buyers, they need independent dealer buyers, they need lots of buyers. They all can't be sold back through their network.
Our next question asks, do you track upstream off-lease sales by OEM, and are you seeing any increases there as automakers try to avoid swamping the auctions with volume as they try to kind of control residuals?
Oh, certainly. I mean, it's increased, you know, quite a bit. And again, when the prices are right, I mean, that's you know, the most efficient way to move the vehicles. But again, I think it becomes a little more of a difficult proposition. And of course, the truest form of price discovery is still the auction process. So to the extent that you want to do upstream non-competitive bid type pricing, if you're just going to give the grounding dealer a great bargain, then you know, at some point you got to find out what market values are. And again, the auction process, competitive bid process, is as I said, the truest form of price discovery.
I'm going back to the dealership level. Do you have any stats or any kind of idea on the percent or the amount of trade-ins that new car dealers keep at their stores? And you know, are they sending more or less to auction these days, or are they tending to kind of hold on to those trade-ins that come into their stores?
Well, certainly in the initial part of the recovery, when there was a shortage of late model used vehicles, which is typically what the franchise dealers want on their lots, then yeah, there was they were keeping almost everything. And even when they were getting older, higher mileage units that didn't fit their normal profile, some of the franchise dealers would retail out of them as opposed to their past practices. Some of them even start, you know, separate lots that might, you know, better be able to market those types of vehicles. So yeah, in the initial stages there, that's one of the things that really hurt the independent dealers, because they weren't getting that normal flow of vehicles from the franchise dealer to them. But it is starting to level off a little more now, and certainly the dealers themselves are receiving newer trade-ins now as opposed to what they were getting in the past. The market's getting a little better in that respect, and we actually see it from our dealer consigned vehicles, which you know, traditionally the average mileage on dealer consigned and average age has gone up. It has actually started to tick down a little bit recently.
With the current rate of dealers that are, on the other side buying lease returns being at 45%, where do you see that percentage moving with a significant increase in lease returns this year and beyond?
Again, a lot of it would be dependent on the on what the lessor wants to do. I mean, you have both carrots and sticks to get the grounding dealer to buy units. So how they want to play their program, they can move that number.
And Tom, to touch on another popular topic these days, certainly that we've all been looking at, and that's the Takata airbag issue. How do you see this impacting the wholesale side of the market, if at all?
Well, certainly for different aspects of it. I mean, obviously the recall issue has been a significant issue for everybody. Rental car companies being one, and there's tremendous backlog. I mean, you can see it within the dealer network in terms of satisfying and making all these repairs. So causing a lot of problems, put it like that.
I'm looking at the wholesale environment. Have you seen an increase in the number of cars that are sold wholesale through these online channels, be they different simulcast venues or straight up online marketplaces? And then the second part of that question, to what degree does a condition report on those vehicles kind of help spur those sales?
Certainly, I won't put a percentage increases behind it, but certainly the online environment has grown faster than the total, and is growing, I would say, significantly. It is basically mandatory that that you have good pictures and good condition reports.
We talk about the spring market that always seems to hit, obviously this time of year, and got the weather warming up. And any thoughts on the traditional spring market this year? Are you starting to notice that it's kind of appearing in the auction lanes yet?
Well, one aspect of that would be, the lower end units, which are heavily impacted by tax refund monies. We had the issue with the IRS at the beginning of February, and refunds were down very significantly in the first week of February, but they had picked back up, and I believe by the end of the month they were down about only 3% or so. So those dollar monies are always important. You need to know where the details of how the monies come back. Obviously, to the buy here, pay here market, you're primarily interested in that earned income tax credit monies, and a lot of those of dealers have used what you might call down payment deferral programs, and we're actually making deliveries in October, November, December ahead of that time frame, and so that might have had somewhat of a dampening of what we normally would see, a big movement up in terms of pricing in February and March.
I'm turning a bit to the regulatory world. Do you see, the regulation environment, particularly outfits like the CFPB, playing a role on the lease return side of the business? Are their efforts recently going to impact that side of the business?
Well, it impacts it just because of the not so much the availability of credit, the cost and the compliance cost, etc. The retail finance environment, the dealers have been able to handle it. The lenders have been able to handle it. There were some, I would say relatively significant fines, but it really hasn't negatively impacted in terms of what's going on out there. I mean, it's certainly you can't go any conference without hearing about compliance, etc. So you are increasing costs to that extent.
All right. And we've seen some significant value swings in the electric vehicle segment, and wanted to see what you see as the future for these vehicles. Both in terms of the pricing and the demand side of that equation.
Certainly, some of them have extremely high lease rates. So it is the manufacturer that is, absorbing all that residual risk. Certainly, residual values are negative, impacted from a percentage-wise when the fact that you're not getting that tax credit on the sale of the used vehicle. So it has not been a strong environment. I would say, however, if you look at some of these units, not just pure electrics, but the hybrids, etc., where there was some concern that they would show abnormal depreciation curve when their mileage got high because of assumptions in terms of battery life. That has not occurred. And as you can see, there's been some recent reports where companies have been running these hybrid vehicles, etc., in taxi service, putting an extremely high number of the miles on them with no deterioration in battery performance at all. So that's been a pleasant surprise. But yeah, the overall values are weak. I mean, it certainly doesn't. The cost-benefit analysis is not there with gasoline at $1.75.
Tom, we've got just a couple minutes left, so I just wanted to ask one more question for you, and that goes to the financing terms in terms of the term length. Do you find the extended term length at a reasonable level at this point?
I guess I'm somewhat biased against these extremely long finance terms. I really think that you are breeding the possibility for customer dissatisfaction. On the new vehicle side, typically new vehicle buyers are high-income households. They do want to trade on a regular cycle, so putting them into that 72, 84-month loan is probably going to cause some dissatisfaction when they want to get out at their normal cycle. And for many of them, they probably would have been better off in a lease. On the used vehicle side, I think the major deterrent there again, extremely long terms. So two things are happening. Number one, let's say Wall Street has already sort of said, well, you don't have a next step. I mean, you pushed it this long, but we're not going another 12 months, another 6 months. So you're reaching your limit in terms of getting that monthly payment down further and further by extending the term. The other issue, of course, is that especially on the subprime side, where these people by definition are living on the edge. So if you have a longer contract, there's a greater likelihood that at some point during that contract, they will experience that event which causes default, which is primarily job loss, illness, divorce, etc. Generally speaking, people do make their payments. It's when they have these life events that they don't. So making a longer-term contract increases the possibility that you're going to have that event. And certainly, and we've already seen some of this, an increase in the severity of loss.
Thank you, Tom. Again, we will be sending a recording of this webinar and Tom's presentation to all attendees. If you submitted a question and we weren't able to get the answer to it, don't worry, we're going to forward it to Tom and his team at Manheim so that they can contact you back directly via email. Again, thank you, Tom, and this concludes today's webinar. Thank you for joining us.
Thank you.